I think we'll get started. So obviously a very warm welcome to all our clients. And obviously there's been a lot going on out in the world, and we're seeing obviously all asset classes being affected by this. So Tom, today's going to be an interesting presentation, I'm sure. But before I hand it over to you, I just wanted to also take this opportunity to recognise how well Drummond have obviously done also in the IMAP Awards. I'd mentioned to all our clients that we're clearly quite chuffed that Halcyon's been nominated as one of the 5 finalists in the managed account space, but Drummond have also been nominated in the multi-asset class space. So congratulations.
Thanks very much. That's a good result for both of us this year, particularly in difficult markets. So yeah, we're pleased.
Yeah, we'll head up to Sydney later this month, and we'll see how we go. It'll be a nice night either way. All right, I'll hand it over to you. So if you just want to work through the presentation, I'm sure, as all our clients know, there's opportunity to ask questions along the way by just simply typing in your message in the question box, and we'll endeavour to get through all those as well. So
perfect. Thanks, Brendan. Thanks for everyone for joining us again today. Brendan, just to confirm, you'll monitor the Q&A box?
I will, yes.
Feel free to jump in as we go.
Yeah.
You can see the screen, obviously. All good from side.
Thank you.
So just in terms of agenda today, inflation and interest rates are obviously incredibly topical, and so we will have another look at those and the outlook. Interest rates obviously affects housing, so we'll take a bit of a look at how that may impact or is already impacting the domestic housing market. We'll have a look more broadly then at global economic growth and markets. Recap on some of the changes made to defend portfolios that carried on through the first half of this year, and then what the sort of resulting performance outcomes have been. We'll then take a look at valuations. Valuations across all asset classes have adjusted downwards as a result of higher interest rates, and just where we stand today. We'll look at some of the changes made to the funds in the portfolios, and then also how we're positioned. So let's start with inflation. We've been talking about this for a while now. It'd be nice when we stop talking about it, I suppose, but it's one of those things that's proving to be stickier and more ingrained. When we went back sort of post-COVID, there was obviously a lot of supply chain disruption. We're all locked in our house, shopping for goods at the same time that the factories manufacturing those goods were locked down also. And so that initial spike then broadened last year. We had weather, affecting crops and food prices. We've seen, the Russia-Ukraine war continue to impact fuel prices, energy prices, and then lower interest rates pushing up housing markets is now pushing up rents quite significantly across the board. And so what we're seeing a broadening and pace of inflation, and that's obviously caused central banks to start to increase rates at a much more aggressive pace than what we'd seen in previous cycles, I guess. Yeah, so we're taking a long run look at inflation here. So this is the US going back to 1970s, and really you can see the context of the current period of inflation and the spike that we've seen. So the blue line is core CPI in the US. And I guess what is worth kind of pondering is just how we've been in this real 30-year declining and stable inflation environment. And that's been a really great environment for asset prices. And it's been really easy for policymakers in a way, because you haven't had to worry about these huge spikes. Yes, it's moved around a little bit over time, but it's been well anchored within the bands that the central banks have at that sort of 2 to 3% target. Obviously, this huge spike, is quite unusual, and we've really got to go back to the sort of 70s and 80s to see such a large increase in inflation in such a short period of time. We don't think we're in that environment. There's some similarities between the 70s in terms of war and disruption to energy supplies. But there's lots of differences as well in terms of labour markets. And so we think, yes, that, we're not sort of concerned necessarily that we're going back to a 70s style inflation environment. And it's worth noting that inflation back then was well north of 10. Core at the moment is 6. The reason I'm looking at the US, they report more current data than we do. Unfortunately, in Australia, our CPI data is reported with a huge lag, sort of a few months late on a quarterly basis. We sort of know what it is, but it's the number that's last reported is often a few months behind. And you can see also, obviously, the impacts then on, the yellow line being the cash rate, and we'll talk a little bit more about where interest rates are going across the world. So is this going to persist, I guess, is the question. And so we've built an inflation dashboard some time ago, really to try and monitor the underlying subcomponents of CPI. As I said, a lot of the time that CPI inflation is reported, it's in the rearview mirror. And so, what's going on underneath that makes up the number. And we can start to see, subcomponents, whether it's inventories or prices paid and prices received, starting to fall. And that's a good thing. So it gives us sort of, reason to believe that as we cycle through the next 6 months, that's, sticker shock of the headline numbers being, 9% in the US, 7% potentially in Australia, will start to moderate. When we look at commodity prices, we can already see those falling. I filled up my car on the weekend. It was about 40 cents a litre cheaper than last time, which is, so some signs of moderating inflation, and that's a good thing. But it's not, certainly not back at target yet. Where are interest rates going? And the blue bar here is essentially the current cash rate. The US number has actually gone up last week by another 0.75. So I probably need to update the chart. And the yellow bar is the market pricing of where cash rates will be around the world at about Christmas time this year. So in Australia, we're at 1.35. We've got a meeting tomorrow from the Reserve Bank. We're expecting them to go potentially an unusual number, might do like 0.65 and get to an even 2. They're definitely keen to start getting ahead of this. And so, some bigger rate hike coming through before we basically get to 3% by Christmas. And interestingly, if we look out to 2023, what we can see is that it actually is sort of peak and earlier, which is quite interesting. So even though we are at this really rapid pace of increases, it looks like that's almost going to be the peak in the cycle, at least according to the market. So because of inflation, because they were caught a bit behind the curve, had to do a lot in a 12-month period. But actually, we're going to get to the sort of, arguably the terminal rate a lot faster rather than having a, slow 2 or 3 year hiking cycle. And so, and that's somewhat priced in, or you'd say it's priced into equity and bond markets, and we're now starting to see that priced into housing.
Just to clarify on that, Tom, obviously what we're seeing with the last 6 months, which I know you'll talk a bit more about later, but we're seeing most asset classes have a negative performance in particularly the last 6-7 months. What that's saying is that if we have continued increases in interest rates, we won't still continue potentially to see a sell-off in those asset prices because it's already been baked into the current price. That's right. Really, it happened quite quickly from a market pricing perspective. That if we think about where the cash rate was, these were all at 0 last year. Then all of a sudden, in December last year, we saw the Federal Reserve start. So Jay Powell on the 15th of December essentially abandoning zero policy and saying we now need to tame inflation and we're going to start hiking interest rates. And they did. And the market moved really quickly everywhere, really to price in sort of 2 to 3% moves this year. So that yellow bar happened a lot of that happened in Q1, if you will, the forecast. And as a result, bond markets and equity markets that price looking forward will look at that market pricing and have made that adjustment. The cash rate move is the real economy effect, at least in Australia. And so, you've seen now, you're starting to see that flow through where people are seeing their mortgages go up. We're now seeing a softening in the housing market coming through now because people, at least in Australia, we're linked to that blue bar being the cash rate coming through. But yeah, as you say, most other asset markets have adjusted to the new reality, we think. So we shouldn't be fearful of continued interest rate rises as long as it doesn't surprise on the upside where it's higher than what's already been baked into the potential next 12 months. That's right. Yeah. That's right. Unless you're a mortgage holder, of course, you can then be fearful. And the good news is for savers here is that cash and term deposits are actually making
going to make a comeback. So we're
Okay.
starting to see that, which is a positive from
Yeah, sure.
particularly for those of you funding pensions. It's great.
Sure. Correct. Thanks, Tom.
That's okay. So what does that mean for housing? So a couple of things to note. I don't think I need to explain that we had an almighty boom last year. I think everyone's well aware that house prices went up a lot. And so this was driven by the chart on the right is just housing finance. So you can see from basically 2020 when the Reserve Bank said we're going to anchor rates at zero for the next 3-4 years, everyone went out and borrowed as much as they could. So you saw a huge increase in housing finance, like well above trend growth through that period. That obviously drove a lot of activity in new houses. So this is building approvals, the yellow line, and units have been a little softer. There was excess supply and people actually wanted houses post-COVID because we're all spending more time in them and want more space. And so there was a real spike in, building approvals, houses, and overall activity in the household sector. We're now seeing the effect of higher interest rates. So building approvals are now falling again. Unit approvals are there, and we're just seeing a rollover in housing finance as well. And in terms of where house prices may go, so there's lots of numbers on this chart. Basically, look at the bottom. What we tried to do was build in some sensitivity analysis to higher mortgage rates on prices. So to the extent that a lot of the house price growth we've seen in recent years has been driven by quite a substantial decline in the mortgage rate. You would think that a very rapid increase in that mortgage rate is obviously going to have a negative impact on the market. And so we just wanted to do some on the back of the envelope, if you will, assessment of the impact. And so this is, the baseline, which was a 2% mortgage rate, which was about the lows when cash rate was at zero last year. Already we're sort of up, 3.5. And arguably by Christmas, we're sort of getting here towards 5. That's saying somewhere between an 18 and 30% fall in house prices. We've never seen really a 30% decline. A lot of people will always pay their mortgage or they don't sell. But I guess what we're trying to say here is, the reality of higher interest rates is going to mean quite a bit of weakness in housing. And if you look at the forecasts from major banks and around the country and economists, they're sort of saying in Melbourne and Sydney between 15 and maybe 25%. So it kind of stacks up with where market pricing of interest rates are and what household sensitivity to those rates now is. And so we've probably really only just started. I'd say it looks like at the higher end in Melbourne and Sydney, we're off about 5% already. And so that a lot of that will kind of flush through over the next sort of 6 to 12 months.
Just we seem to have a very low rentals spaces available as well. Will that have an impact and help hold up property prices?
Yeah, I mean, certainly rents. So that's pushing up rents, and that definitely provides some support to the market. Again, there's a few COVID washouts there. So we saw even though the borders were shut and therefore inbound migration fell basically to almost zero. What happened was people moved out or wanted more space, and so kind of new household formation still continued on. So if you had a housemate, you probably didn't want to live with them anymore. Couples moving out from their parents, wanting space, needing an extra bedroom because it's now a home office. All those kind of factors drove some household formation, and so what that meant is it's really pushed up rent for houses, even though the borders were closed. And so to the extent that that's all well and good until you can't afford the rent, and the young couple moves back home or people move back in with each other. Like, it's all good when things are fine where you don't want to spend your money on anything else, but these things are sensitive to higher rents and higher rates, I would say. So there will be some offset, at least in the short term, higher interest rates, higher rents, and that's good if you're a property investor. Mm-hmm. But to the extent that holds through time will be interesting to see. Let's take a look at sort of global growth now, and it's slowing everywhere, I guess, is the big picture. So the US economy, this is our growth barometer, has now turned negative the third month in a row, and yellow bar is actually the housing sector. So in the US, they actually link their mortgages to the 30-year bond rate, and that sold off during the first quarter. So they have already this year seen a more than doubling of their mortgage rate. Now, a lot of that is fixed, but it does affect obviously new purchases and what happens in the housing sector. And similarly, they're seeing a downturn in building approvals like we're seeing here in Australia. So the housing sector and now and with it the consumer, which are obviously linked, are starting to drag on economic activity. Fiscal stimulus is kind of worn off, and that's a theme that's again kind of global in Australia as well. There were lots.
To clarify that fiscal stimulus, we're talking about printing of money and bond buying programs.
It was all the JobKeeper and JobSeeker, all the extra cash handouts from governments in COVID. They were really significant and put a lot of extra cash in people's pockets. They aren't continuing anymore, and they sort of wound up at the end of last year in most countries. And so this year, the consumer doesn't have the benefit of previous 2 years, they've had extra income in their pockets from the government. And then this year they don't have it. And so there's a net sort of dragging effect on the economy because most of that extra money was spent. And so that sort of drags on demand. And then at the same time, this year, people have less kind of in their pockets after what we'd say is real income. So after inflation. So because of the increase in petrol costs, food costs, rent, what's left over to spend on discretionary items and really drive consumer demand is not there. So there's a sort of double tightening, if you will, on the consumer. And we are starting to see that drag on economic activity. So the US has just printed the last week, the second quarter of negative GDP growth. So Q1 was negative, Q2 was negative. That's a technical recession. They don't call it a recession until it's announced by the government agency, but it's a big slowdown, right? And we're seeing that in activity.
So does that make it official in the US that they're in recession then?
No. So they have to wait until the National Bureau of Economic Research, the NBER, declares it, and often it's really late. Quite often what happens is they declare it, and it's from a market's point of view, it's the end of the cycle, and it's a time to buy because again, it's looking really quite far advanced in the rearview mirror. So they're not there yet, and they may not declare even that. So President Biden and Jay Powell, the head of the Federal Reserve, came out last week despite announcing 2 quarters of negative growth and said this is not a recession, which is good of them. But the data suggests the economy is coming back. So Asia has been really weak, again driven by China. I think we've spoken at length in previous updates about the Chinese economy. If we have a look, the increased regulation that they put through last year has just dragged on confidence in multiple sectors of the economy. But the big one this year really has been the pursuit of zero COVID. They have continued to roll through lockdowns right across the country and shutting large parts of the economy. And we've seen here that basically that's COVID. So massive drawdown in growth activity. Similar outcomes this year, actually. So it's quite unusual. We didn't think we would go back to that kind of contraction in activity anywhere. And China's done it by persisting with zero COVID. They will literally lock down a city of 5 million people for one case at the moment because they're petrified of an outbreak. And all of this is putting a real strain on the really large housing sector. So combination of sort of tighter policy and activity, lockdowns, and now we're seeing sort of falling house prices, straining some property developers. So there's a real stress on their housing sector, which is, it's massive for their economy, but it's also massive for our economy and the demand for resources and more broadly for global growth. So it's something we continue to monitor quite closely. They are saying everything's going to be okay. There's a little bit of stimulus coming through, but it's definitely weak in China at the moment as well. Australia's not been so bad. We've been much better insulated this year. A few factors. One, strong commodity prices have been a real story as a result of the inflation out and strong growth last year. So we saw really high commodity prices lead to a really buoyant resources sector. Secondly, the strength in the housing market last year flowing through to the consumer economy. So people, higher house prices make everyone feel wealthier, lots of activity in the building sector, lots of money flowing through the economy. And so that's been a positive that may, as we said, turn into a negative or a drag going forward. And broadly, the labour market's been really resilient. So unemployment's under 4%. It's really hard to get people, to be honest, and they're getting paid more. And so, robust consumer, a labour market means robust consumer. But we are starting to see the impact of higher rates on Australia and dragging just a little bit. Now you can see the dark blue bar as the consumer just pulling back a little bit. In terms of activity, so given what's happened this year, and we'll sort of look at the market outcome shortly, but we were quite active early on, late last year, reducing sort of the riskier parts of the portfolio, in particular the interest rate sensitive parts. So all assets are sensitive to interest rates, so higher interest rates, lower valuations, but some are more sensitive than others. And so really making sure that the ones that were really sensitive, we were reducing or getting out of altogether when that outlook for interest rates changed. And that really has left the portfolios pretty well positioned this year, because that's been the primary driver of the volatility. So we're out of small caps and technology shares. General, just holding more cash. I think at the last webinar, just saying we're playing defense, not offense this year. Focus on the capital preservation element, and that's largely carried through. We started to buy some government bonds after they sold off a lot in the second quarter. We were a little bit early on some of those, but we kept sort of averaging in at higher yields. And then this last month, actually, some of those positions are up 5% in July, which is great. So using that to our advantage. So some of the sell-off in government bonds we used to add to the portfolios. We've switched from sort of equities to infrastructure, which is more defensive and also has better inflation pass through than some equities. And so generally running underweight equities within equities and risk assets, being more defensively positioned anyway, so holding less interest rate sensitive parts of the portfolio and just holding some cash as a defence as well, has left the portfolios reasonably well positioned throughout the year. So how does that sort of stack up on a financial year basis? So these are the returns for the Halcyon portfolio series over the FY22 year, so ending June 30, versus markets and some of the peer indexes. So great outcome in terms of preserving on the downside. Highest risk portfolios being the high growth and growth, really only down 5%. When equities are down, 12.5%, even bond markets down 10%. And this has probably been the real difference this year. In a lot of previous equity sell-offs, bonds would be up. So in a diversified portfolio, you would have some offset from the lower equities with higher bond prices. And in particular, these sort of balanced and growth portfolios that might own 50% growth assets, 50% defensive assets, that's been a really good way to defend the portfolios. And so we didn't have those levers this year. The bonds actually performed in Australia worse than equities. So Aussie bonds down 10.7 versus the ASX down 6.5 is really unusual and hasn't happened for a very long time. And so largely we didn't hold really any government bonds going into the worst of the sell-off, and we started to rebuild that through Q2. So we used sell-off in bonds to buy rather than be forced to sell, which was good. So that sort of helped on the downside. We'd hedged the portfolios just with cash rather than bonds. And similarly, just holding less equities has really left the portfolios in a good position. So an outperformance, versus the peer indexes. So these are kind of peer indexes, and a strong outperformance versus the major markets, if that makes sense.
So effectively, Tom, in that 12-month period, there was no asset class you could really hide in.
No.
I guess one of the frustrations I have, and I guess one of the questions that you might be able to clear up for me, we see some industry funds, one in particular, that actually announce a positive return in that same period. And I know we've got our balanced and our growth peers there, because that is the average of a big group, but there's obviously going to be outliers. And how is it that they, in this environment where there's really been nowhere to make money, how is it that they've been able to generate a positive return?
They haven't valued all of the assets in their portfolios at the current value, which...
Can you explain what that means? And
yeah, sure. So what we manage with yourselves on platform, and what we're referring to here, a daily price mark to market. This is the real valuation today, and willing buyer, willing seller, like every day. All of the underlying assets within the portfolios, you got to remember, managed funds are made up of, you know, tens, if not hundreds of different underlying shares, which are traded on an exchange somewhere in the world, you know, 5 days a week. And so the price that is reflected in the value of your portfolio reflects, you know, the whole world's view of all of the things that have affected markets to date, the effect of higher interest rates, the effect of the fall in bond prices, you know, all of the inflation outlook and the uncertainty is all captured, you know, today in today's price. It is the sum of everything we know. And so it feels like it's a real valuation in our view, because there's been a clearing price, and the sellers and buyers have matched at that point to capture all of that information.
So
the industry super.
When you say mark to market,
yep,
that's what you mean. It's actually today's price. It's marked to today's price.
Exactly. Everything in the portfolio is, and that's really important here. So the industry super funds, and it's not a bad thing, they have progressively over time invested more and more of their portfolio in unlisted assets. So, you know, some big transactions earlier this year, like Australian Super was part of a syndicate that took private Sydney Airport from the stock exchange. So rather than Sydney Airport trading every day on the stock exchange, giving us a live price, it is now in hands of private investor, being the super funds and their investor parties, if you will, and they value it. There's a single valuer essentially. So they build a model, someone signs off that valuation, and they might only do that once or twice a year at best. So it's not every day. And that's fine. Over the long term, that means it should result in the same outcome, because a lot of the valuations done in those private assets or unlisted assets do over time have to capture what the public market asset valuation is as well, because that's, you know, the two are not the same. You know, the two are not different over the long term. But in the short term, the delay in updating that valuation means that, unfortunately, I think that some of those assets aren't capturing all of those things. So what's most unusual is the interest rate piece. We accept that equity markets will probably sometimes go above and below fair value, because they are driven by a bit more noise and human emotion than they trade every day.
More volatile.
Mm-hmm. More volatile. That's just the nature of them.
Mm-hmm.
But the big one for us is interest rates. When you've had a 10% sell-off in the bond market, which has been interest rates going from 1%, bond yields going from 1% to, you know, 3.5%, almost 4% in Australia, that is one of the biggest sell-offs actually in over 40 years. So biggest adjustments in bond rates. That is a critical component of valuing unlisted assets. And so one of the key line items when that valuer builds the spreadsheet valuing Sydney Airport will be, what 10-year bond yields will we put in there? And the higher the bond yield, the lower the valuation in a big way. That's the nature of those valuation models. And because they haven't updated the valuation of those assets to reflect that, that's why we think there's such a big disconnect this half. You've had the biggest sell-off in 40 years in the asset class that underpins the valuation, and you haven't adjusted your models. It's not been a small adjustment, it's been such a significant adjustment. And a great example of that, Host Plus, who came out advertising how well they'd done, being number one for the year in the sector on like the 3rd or 4th day of July, is amazing, because 45% of their portfolio is unlisted. So you can't tell me that within 3 days of quarter end, you've managed to revalue 45% of your portfolio that doesn't have a market price. No one could do that. And interestingly, the regulator came and asked them some questions, and it turns out one of their biggest underlying private investments, which turned out to be a disproportionate part of their portfolio, a single company, which was 3% of the portfolio, copped a 30% devaluation. So that one company downgraded in July took 1% off the performance of the portfolio. And it doesn't sound like a lot, but 1% from a single company is a really, really big contribution to return. And that almost turned their positive return to a negative return. That's how significant it was. And so the fact that they had one of those, and they've got hundreds of those doing that, and that happened 3 weeks later after them advertising that had positive performance, kind of tells you how big the disconnect is between everything else that they're still holding at valuations of 6 months old versus where they are today. You can't have, NASDAQ and tech stocks down 30, 40%, and all of the private equity investments they hold being up 10, or public listed infrastructure down 10 and their unlisted infrastructure up 10. So it's not that they reported even flat returns. They actually reported increases because they were still relying on valuations that were 6 months old, when the rest of the world has adjusted these things down. So the discrepancy between theirs and the public markets is, in some cases 30 or 40%, and it's just too much.
Yeah. So we should see an adjustment to that potentially in the next 6 months or so.
It'll wash through. They're progressively now, all those lagging, delayed valuations, the unlisted ones, will be progressively updated over this 6 month period, and that'll drag on the returns of the industry super funds on a quarter by quarter basis. Yeah.
But they've done their marketing to suggest that they've had positive returns that everyone reads. So
yeah, it's not. I think it's a bit disingenuous, to be honest. But
it's a question that is asked, and I think it's something that we need to address.
Yep.
We obviously focus on what we do and how we do it, and we compare that to a very broad set of peers to see where we stand. But it's interesting those that, when there are positive returns being announced, well, how's that the case? And I think an explanation's warranted. So thanks for that, Tom.
No problems. Conversely, on the other side now, I think, if you look forward to next year, and at some stage markets sort of bottom out this half, we think we can sort of talk about the outlook a bit more broadly, but we've done it. We're a long way through this cycle, this down cycle, and there may be a little bit more volatility in the months ahead, but at some stage it finds a floor, and next year looks good. Potentially you get a good recovery off those lows. Conversely, these portfolios are marking off the lows, and so you'll see a good rebound on the upside, whereas we won't have any dragging unlisted valuations to deal with. So it's just a timing issue. In the end, point to point, we all end up in the same place in terms of valuation, but the timing of those valuations really matters, I think. And ours are live, and that's really important.
Yeah, thank you.
No problems. Just looking at long term, so that was looking at the 1 year performance to June. So good 1 year performance, locking in really over all time periods, short and long term now, adding 2% plus versus those large institutional peers. You can't can't hide numbers over the long term. So really, really pleasing to see that consistent outperformance. In particular, been a reasonably challenging environment. We've had 2 bear markets over that journey with you guys. So starting in 19 and then wading into COVID, one good year last year, and then we're back into a bear environment this year. So actually generating positive returns are sort of 4 to 5% in your sort of balanced and growth portfolios versus peers at 2.5%. That extra 2% per annum really adds up.
Absolutely.
So it's good to see. Why you were nominated for an award this year?
Well, no, I'll stop pumping up our tires, but yeah, you're right. Correct.
In terms of valuations, you would have seen this before, but just to recap, the pink dot is the current forward PE ratio of the market. So that's a method of valuing the equity market. The blue line is the long-term average of those markets. And I just thought it was worth referencing from 12 months ago, this picture, because I think we would have spoken about it last year, that valuations look pretty elevated to us. And I think the message was that's all good unless interest rates go up a lot. And so you can sort of, tying the picture together now, when the outlook for interest rates changed a lot late last year, you can see why we made such big adjustments to portfolios, because we were worried about this interest rate sensitivity. Fast forward to today, and you can see a big compression in that valuation. So the PE in the US going from 24 times to sort of 18 times. That's a big fall. And you can see now a lot of market, even Australia was close to its peak at 20, is now getting back to its long-term average of 15. So that's good. Markets aren't screaming cheap. They're not miles below, unless you're in the UK or Japan, low average, but they've certainly taken away all of that premium largely. The US is close to doing that. There's some argument that that's deserved given the type of companies, the quality of the companies that have technology, etc. But certainly some of that real excessive premium we saw from a valuation point of view has been taken away. And to your earlier question, how much is in the price? Well, you would say a lot of that, certainly from an interest rate perspective, the effect of higher interest rates, we believe, is now being captured in lower valuations, and that's a good thing for markets going forward. Just look at some of the different managers. So getting some context around things we'd sold in the past, to be honest. So we'd been progressed COVID winners. We had those managers that owned a lot of tech stocks and did really well, the Amazons and Googles and Microsofts of the world. They did really well for us for a long period of time, and along came higher interest rates. They're really valuation sensitive, and so managers that we used to own, like Hyperion and Magellan, we don't own anymore. They were all gone last year or year before. You can see this year to date, Hyperion's down 30%, and Magellan's down 20%. What we'd been looking to buy is funds which were focused on parts of the market that were better value, that were more in line with their long-term equity market valuations, and as a result, not as interest rate sensitive. And so Hanley down 3.5% year to date, GQG down 4.5% versus the market. This is calendar year to date, which is down to 16%. So a big difference between those that were focused on valuation and those that were focused not on valuation but long-term growth. And so big dispersion there. But we've sort of hidden well, and this has partly driven some of that relative performance this year, by avoiding these really sensitive, interest rate sensitive parts of the market and picking up the managers that are more valuation focused.
So those obviously the funds that we decide on using is an important aspect of building our portfolio. How many fund manager meetings do you think would take place in the course of 12 months?
So the team, we track all the meetings we do, fund by fund, sector by sector. Last 12 months was 287.
Enormous. Yeah.
It's a good workload. But it's how you keep on top of all of these little issues. And so, of course, we run a focused set of best ideas, which we're bringing to you guys. We're able to have lots of, if we own managers, really, really frequent meetings with the ones that we own. So we're right on top of any changes that we should be aware of or need to be aware of, rather than just trying to cover the whole market. So it's a real high conviction approach to the research program.
Yeah.
In terms of how we're positioned at the moment, so I guess the overall message is we're still playing defense, not offense, albeit we're starting to get closer to potentially changing that. Portfolios remain underweight growth assets or overall, really driven by an underweight to global equities. We're neutral Australian equities, so we're in line with our strategic allocation. Property and infrastructure are all neutral, so the other more defensive growth assets we're holding a neutral position to. And the big shift on the defensive side of the balance sheet has been, I think for a long time we were underweight government bonds and overweight corporate debt. Corporate debt is economically sensitive. Because we're now concerned about growth slowing, the R word, recession, bringing around lower corporate earnings, we've sort of gone the other way. So we're underweight corporate debt and overweight government bonds and cash. And so we're still pretty defensive. And the market at the moment is going through a little bit of a relief rally recovery, which is good, but we still think that the next few months has got a few challenges. We want to see the rest of those rate hikes from the central banks be pushed through. We would like to see those forward-looking indicators we've got on inflation actually materialise in slightly lower CPI prints, confirming that, and also giving the central bank some cover to slow the rate of increases from here, and also the effect of all of the slowing growth going forward being captured in more realistic earnings forecasts. So we're seeing quarterly earnings in the US about to go into Aussie reporting season. It's a bit of a mixed bag. Some companies doing better than others, others reporting really soft outlooks as well. And so, but it's still, in our view, a little bit too much optimism on how good next year is going to be, like 10% earnings growth in 2023. That to us feels a little bit elevated, given we're sort of looking at no growth or potentially slightly negative growth from here. And so we'd like to see those expectations come down as well. And if they do, then you're really probably somewhere near the bottom of this current cycle. So we're actually been, from a research point of view, we're now going back and revisiting areas of opportunity. So having played defense for most of this year and having a lot of cash and bonds in the portfolio that we could redeploy, I guess, into opportunities on the upside, in equities, if you will. We're now back revisiting those. So things that we don't own, like small caps that have done really badly this year, and some of those technology names that have been sold off a lot. There are funds out there that are down 50, 60%. Start to look interesting. And so rather than just being focused on playing defense, we think we've done hopefully most of what we need to there. We're now actually starting to turn our eye to opportunities, so that when, as I said, those kind of combination of factors build up to give us confidence that this current downswing is somewhere near the end. And you're never going to pick the bottom perfectly, but if we believe that the conditions are ripe and the valuation is there, then we'll just start to progressively redeploy, and that'll set the portfolios up for hopefully a good 2 or 3 year period from there.
We're hopeful that we might see the low point in the share markets this calendar year. That's
yeah. We're heading that way.
Do you track the changes that you made to the portfolio to see if they added to the performance? Like, how do you track that?
We got an external risk system, which every transaction that we put through with you guys gets tracked in that system, and it attributes the changes to asset allocation calls like this, being overweight or underweight equities, and also the managers. And pleasingly, there's value added from both. I mean, the output is the performance we spoke about earlier, so the sort of plus 2% per annum ahead of peers, but it's coming from both the calls on how much, being overweight or underweight equities, but also the managers within the portfolio adding over time.
And what happens in the instance, Tom, just to explain your process a bit more, if we want to sell an investment and that investment perhaps hasn't done what we want it to do, in fact, it may have lost money.
Yep.
Do you wait until it gets back to the price that you paid before selling? Or if you have... Not
if our thesis has changed. So look, the reality is it's a really humbling thing that you do in investing. And we've got statistics on this we can share with you, but 6 out of 10 is a good hit rate on decisions. So that means for every 10 decisions you make, 6 out of 10 are good, and 4 out of 10 are bad. And I know that sounds like that's a lot of bad decisions, but what it actually comes down to is how you manage those decisions. And so really what you've got to do is don't worry about the 6, because they're in the portfolio and you let them compound. If they're working for you, let them working for you, unless you think the thesis has changed. But what we're worried about all the time is that every day we come to work is the 4 out of 10 decisions that are in the portfolio that are potentially not going to be good ones, and we need to remove them. And whether some of them may be up, they may have done really well, and no one wants to sell them because they look like they're the best you've got, or conversely, they may be going against you and you may have to take a loss, and that's also just a part of investing. You need to be pretty unemotional about these decisions, and when the facts change, we change our mind and develop and evolve the portfolio accordingly.
Yeah, no, it's fine. So happy to move on.
Okay, that's almost there. So I guess in summary, we think market volatility this year has been driven mainly by inflation and the increase in interest rates, with a really aggressive central bank's tightening policy. China's growth is lagging and isn't likely to rebound like it has in the past, because they can't stimulate the housing market as they've done in the past. We have seen a bit of a pickup in portfolio activity, but that's been driven by the volatility and the need to defend portfolios, focus on capital preservation. We have seen a derating in valuations, and it's starting to present opportunities. So we're spending a lot of time hunting for the things that we want to buy when we're ready to buy, and that's exciting. It sort of tells you we're getting closer to the end of this down cycle than the start. There is a recession risk for 2023. I think, as a word of kind of warning or caution, that word's going to start circulating more and more as these negative numbers come through. It's not going to be a GFC. We're not in that environment where banks are going broke. We're worried about counterparty risk, a big kind of credit event. It's a more vanilla. Central banks have raised interest rates quickly to slow economic activity, and we will see that pull back a little bit after a really strong, year last year. A bit of a kind of vanilla, if you will, recession of the past, and then it will give the central banks pause, on interest rates, potentially even cutting later next year. So it's not don't be shocked, and I think the market's already starting to price that in, and we'll do so this half. And once we think that's captured, then that'll be the opportunity to buy. So don't be concerned about the media beating up, oh, we're in a recession. It actually may be exactly the point that we want to start buying equities, because all the bad news will be in the price.
When everyone else is fearful, hey?
That's right, exactly. And then finally, it's probably still the biggest risk out there. It's geopolitical tensions. Russia, Ukraine is still ongoing. It is dying out, but the risk of Russia doing something else is real, and probably more so China. They're being really aggressive in policy. Xi Jinping is anointed for life in October this year. You saw over the week, Nancy Pelosi from the US is on her way to Taiwan as we speak, and a lot of elevated sort of conversations and warnings, if you will, from China to the US about that, and China to Taiwan about that. So there's definitely risks. I guess the biggest risk to markets and the outlook just remains things that we can't control, and that's the autocratic politicians in China and Russia mainly.
Tom, I've got a couple of specific, if we can, if you're finished now with what you want to.
Go for it.
I've got a couple of specifics. Some you may want to come back to us on, but one in particular. We talk about forward-looking, and markets are very forward-looking, and the research that we obviously rely on focuses heavily on where we see things going as opposed to where they're at right now. And one of the hot topics is obviously around electric vehicles.
Yes.
And a big part of that is obviously with the batteries, with the lithium resources.
Yes.
Do you have a view as to what your forward research is telling us around lithium as an asset?
Look, it's a finite base metal resource, and so all the kind of usual outlook. We don't have a specific view on lithium. Some of the managers that we've owned in the portfolio have had exposure to that and have done quite well from it. It is, like most commodity prices, very volatile. Other components in electric vehicles and batteries, nickel and copper, also had an amazing start to the year, or had amazing 2021 and start to this year, are also now down 20 or 30%. So commodity prices are volatile. The cure for higher prices is, they say, higher prices, and it causes sort of pullbacks in demand. So I think the greening thematic is real, and there's a lot of the managers that we talk to now. So as a broader kind of topic, it's now widely accepted that we're moving towards zero carbon in the next 2 or 3 decades, and there is this huge investment in all kinds of renewable infrastructure to get there, whether that's wind turbines, solar panels, hydrogen projects, energy efficiency projects, electric vehicles, batteries, etc. So there's it's not just about electric vehicles and batteries anymore. It's really more broadly, this is where the whole world is going, and anyone that can innovate or create good product and solutions along those lines is going to be a really strong investment proposition. And so where it was really narrow, so the infrastructure managers that we own in Clearbridge, and they're focused on some of the renewable energy producers, so wind and solar. So we captured the thematic through there. The Aussie equity managers we know are looking at lithium miners, because we have a few listed in Australia, but also copper and nickel miners, because they're really important as well. We see global equity managers focused on subsectors of the sort of green economy, particularly in Europe, which could be a combination of those infrastructure plays, the material plays, but there's actually, the car manufacturers, energy. There's a lot of energy efficiency businesses that are coming out, robotics and so on and so forth. So it is arguably the biggest investment thematic on a go-forward basis in the world, like just as big as technology was in the last 20 years. The move to zero carbon, and all the managers in the portfolio we talk to in one way, shape or form have their own approach to trying to capture those opportunities.
And I guess that's a key, isn't it? Considering how you're saying, you've got lithium as an example, it's down 20 or 30%. But having the diversification and picking the right horse is really important. And if you got all your money on one and it has that sort of volatility, it's not great for performance. So having
you're just relying on a single stock a lot of the time as well, and so particularly
in that area,
down that end of the mining spectrum is pretty spicy. Like lots of production delays, issues on contracts and development and costs and things that are out of a lot of idiosyncratic risks that you need to manage. So again, as you say, building that within the theme is huge, as big as we've ever seen. And I dare say is probably emerging as the biggest overall investment thematic in all portfolios, really, and to capture it. Lithium will just be one part of the story.
Just one final question,
Sure.
Tom. Obviously, you have similar assets in different parts of the world. For instance, the banking sector. So we have obviously the Aussie banks that we're invested in. We have global banks. In the US and so on. Do we find as a result of that we can have the potential impact of more in one asset class than what we would like? How do you manage, like for instance, one asset class like the banking sector when you're using so many different managers and you got various countries that we can invest in?
Yeah, I mean, good systems helps a lot. So we're focused on. We don't want to have. We're happy to take active bets on things. I think that's probably one thing. If we really have a high conviction in something, we're happy to have more exposure, like we did in 2020. We had a lot of technology because it was the only thing that was working, and we sort of actively took a position that was overweight to that particular segment. But we monitor. So I think in the quarterly, there's a chart that we helped you put together, which shows the look through of the underlying, regions and sectors of the aggregate of all of the underlying managers. So we capture all of that data and monitor it. So we don't want to have too much exposure to interest rates or a particular country necessarily or a particular sector. So we monitor all of those risks as just day-to-day kind of, best practice in portfolio management. And if we do see for whatever reason that we're creeping in a direction that we don't like, sometimes that can be a catalyst to make some change to a manager or holding, because it's about managing risk as much as it is around the opportunity, not because we think they're a bad manager, but just the combination of the ones we've got is resulting in, as you say, like some big tilt to banks that we think maybe is too risky. So we do monitor those risks.
I said that was the last question, but if you don't mind,
Tom, go for it. One more.
I've got one more for you, and this is coming back to the resource sector and around the renewables and the big push to that. What does that mean for the what we call the old resources in coal and oil? I mean, are we talking decades before we're no longer relying on those? Like, is that going to play out over many years? What's your view on those old resources?
So I think this year demonstrates that we're not ready to transition 100% in 1 year. I think the whole concept that we could do it was accelerate. In 2020, we shut down the global economy, and so the demand for traditional energy wasn't a problem because no one was flying planes and we weren't driving very far. And if anything, it accelerated the sort of whole push towards renewable targets, green targets, so on and so forth, which is a great thing long term. There's no doubt about it. But it's unfortunately, renewables still are making up less than 15% of total energy production globally. So we've got a huge gap to fill, and we do need some transition to that. Gas prices have gone up a lot, but gas sort of is cleaner than coal. So layering that in over time, unfortunately in Europe, they shut down a lot of nuclear. That would have been a good baseload replacement over coal, which they'd also shut down, but now they've got gas prices up 500% as a result of the war. And so sort of moving too quickly is obviously creating huge economic pain through higher energy prices. So we definitely need to be sensitive to that. I think in the end, we all agree that we need to get to zero carbon. We need to stop global warming. But the path to get there is pretty bumpy. So in our kind of longer term modelling, at least over this year, we think inflation volatility is probably going to be here to stay. Like it's going to go, we're not going to see that sort of long-term stable period of inflation. And a lot of that's going to be driven by volatility in energy prices, which will ebb and flow as we see more renewables come online, different mixes of energy be brought to the table in terms of, and maybe we do more nuclear, build more nuclear. But importantly, I think you'll see oil prices stay pretty elevated because it's going to take, there's no new investment really going into oil and gas, and yet we still need a lot of it every day and in the world for all sorts of transportation and heating and energy use. So the old ones aren't dead yet. There's actually an energy, and one of the managers, GQG we own, have done very well this year just by owning a lot of energy companies that no one wanted to own. And some of the ones they own overseas are on dividend yields of like 25%. I mean, it sounds pretty good. Obviously, you've got to take the volatility that comes with owning an oil and gas stock, but a 25% yield on a big company like a Chevron or an Exxon or whatever is pretty attractive. So definitely opportunities. Coal's probably the hard one. In the short term, there's a little bit of coal being turned back on, but obviously it's one of the dirtier polluters. But I think oil and gas particularly have still got a long way to go before we replace them fully. Other bulks, so iron ore looks pretty elevated still, given the potential slowdown in China housing, but we always do well in Australia because we've got high quality iron ore and low cost of production and unlimited supply almost. So in the end, sort of lower iron ore prices will create some opportunities in those large bulk commodity producers like the BHPs and Rios again. But you just got to take, again, like investing in resources, you've got to be pretty tolerant of the cycle.
Volatility. Well, Tom, we're about to click over an hour, so I appreciate your time as always. And to our clients, we'll put this on the website and we'll send out a link for when it's available. So if you want to have another listen, or anyone that you know that may be interested in any time, click on the website link and you can have another look. But until
thanks
then,
everyone for joining.
Yeah, and we'll good luck later this month. We'll see you up there.
Cheers. Bye bye.
Yeah, thanks, mate. Bye for now.